Good day, grade 8. This is your third lesson for term 2 and it is on forms of ownership. You will find this work in your textbook on pages 134 to 148. We're going to start with the introduction. When a person wants to start a business, one of the first decisions they have to consider is who is going to own it. Is the entrepreneur going to own it alone, or will the ownership be shared with other people in a partnership, a closed corporation, or a company? Now, each form of ownership has its own characteristics, advantages and disadvantages, and the entrepreneur will have to consider each of these, and as well as the circumstances before the entrepreneur decides which form would be the best. Okay, so when an entrepreneur starts a new business, he has to decide about the form of ownership. And the form of ownership depends on the personal needs that you have, as well as the requirements that you're going to need from the business or that the business has. Then each form of ownership possesses its own characteristics, advantages, and disadvantages. Now, just to quickly stand still there are certain questions, and that you will find on page 135 that you need to ask yourself when you want to choose a specific form of ownership. Now, a few of the questions are like, who is going to run the business on a daily basis? Who is going to put money into the business? And who is going to take the risks of if the business financially fails? Who is going to receive the profit of the money? And what are the formalities to the business? How much money is needed to start the business? Okay, now, in terms of the certain terminology that we're going to use when we're going to discuss the forms of ownership, you might ask me, ma'am, but what does formality mean? In the next slide, we're going to just discuss and stand still with a few of the different types of keywords that we're going to use in this lesson. Keywords that are very important when you study and prepare for the exam, and in future when you're going to continue with business studies, is you need to know what the word formality means. Now, formalities are the legal requirements in terms of documentation that you're going to need. And that will also determine which form of ownership you're going to make use of. Some forms of ownership's formalities are less PT and less expensive and less lengthy than others. Not as lengthy as the other forms of ownership. So that is going to influence your choice. Then the second keyword that we're going to stand still with now is separate legal entity. Okay, now some businesses are registered as a separate legal entity with the government, which means that the business is seen as a separate legal person, which has its own name and can trade as a separate person from its owner. So the business then makes business agreements in the name of the business and not in the name of the owner. So if suppliers, customers, or employees feel that they have been badly treated, they can sue the business, but they cannot sue the owners of the business because the contracts they entered into were with the business, not the owners. So if your business is seen as a legal entity, then and your customers are unhappy with something, they can't sue you as an owner, only the business. But if you are seen as a legal entity, they can sue you. So what does the word separate legal entity mean? A company has a legal status separate from that of its owners. This means that a company can buy and sell property on its own name, sue and be sued, and enter into contracts. So in other words, the company is seen as a legal person and not the owner, or a legal entity and not to the owner. And that is actually a very safe place for you to be if your company is seen as a legal entity, because then the company, will carry the risks. Okay, then we're going to look at limited liability. What does that mean? The owners of a legally registered business have limited liability, which means that if the business goes bankrupt, then the owners would only lose the money they invested in the business and not their personal belongings. Okay, so limited liability means that the owners are not personally responsible for the debts. So if your business goes bankrupt, they will not go and take your car, your house, your cat, your dog, everything. They will only take the money that has been invested by you in the business. That means the business is seen as the legal entity, therefore the business carries the risk on your behalf for financial losses. Okay, Then we have the fourth term that I want to explain to you, and that is unlimited liability. Now, in this case, some businesses are not registered as separate legal entities. And so all the contracts are with the owner and not the business. Because of this, the owners have unlimited liability, which means that the owners could lose their personal possessions to repay any debt should the business go bankrupt. So unlimited liability is when the business is not seen as a legal entity. You, the owner, are seen as the legal entity. So you can lose or could lose your personal possessions in case of bankruptcy. So if your business goes bankrupt, in order to repay that debt, they might take your house, your cat, your dog, your car, everything. Now, different forms of ownership. We are going to look at the different types of forms of ownership that we're going to discuss. And it's sole trader, partnership, companies that consist of private and public companies, and closed corporations. Just note that closed corporations you cannot start a closed corporation anymore. But if you started a closed corporation 10 years ago, you can commence with it. You can still have your closed corporation. And then later on, when you want to change your closed corporation into a private company, you can do so. But unfortunately, you cannot turn a private company into closed corporation, and you cannot start a closed corporation anymore. There's no provision for that anymore. But you can continue as a closed corporation if you did start a closed corporation 10 years or longer ago. We're going to first look at the sole trader. Now you can see the picture there, be your own boss. So the sole trader is a business that is owned and managed by one person. It's owned by one person. There are no legal requirements to start and run a sole trader. That's a good thing. It's a benefit of a sole trader. And although some sole traders might be required to obtain a trading license from their local municipality, that's basically the long and the short of registering a sole trader. You need a trading license. So as the only owner of the business, you have the freedom to run it however you want. And you get to make all the decisions that affect the business. The owner also gets all the profit, which is very good. So the harder you work, the more money you make, which can motivate you to be successful. Because the owner and the business cannot be separated, that means that in a sole trader, your business, let's say ABC Stores, you are a sole trader of ABC Stores. When you have a sole trader, your ABC Stores is not seen as the legal entity. You are the legal entity, and you and the business are two separate legal entities. So all assets and debts belongs to you, the owner. So you have unlimited liability, which means that your liability goes on and on and on and on. You are liable to pay all the debt back. If you do not, they will come and take your personal belongings, your dog, your house, your cat, everything to pay off the debt. Sole traders are usually small, and they are suitable for small businesses like hairdressers, plumbers, electricians, financial advisors, a repair shop, small businesses. It is also suitable for small shops selling locally made clothing or groceries, a bakery or a butchery. So those are the kind of businesses that will usually start a sole trader. A sole trader is taxed on any profit made by the business. So the money that you make in the business is your profit you put in your pockets, you as a sole trader. So you are taxed on that. So your tax will be higher. So the more you earn, the more tax you will pay. You will also be held responsible for the debt of the business. And as we already explained, you have unlimited liability. Then another thing about the sole trader is that if you are a sole trader, and let's say you pass away or you can't run the business anymore, then the business will cease to exist. So therefore we say continuity is limited. Continuity is limited. That means that if something happens to the owner, the business needs to close down. Okay, now we're going to look at the partnership. What is a partnership? A partnership is an agreement that consists between two or more people. You cannot have a partnership with one person. You need another person. So it's 2 to 20 partners. It was like that always. Now it is a minimum of 2 partners, and you can have as many partners as you want. So it may happen that when you're a sole trader, you want to expand your business, but because you need additional capital, it's hard to put capital in a business if you're the only person. So it's good to actually have a partner that helps you to put capital and skills into the business. Or another reason might be that the bank may not be prepared to lend you any more money. So then the alternative is to take one or more partners into your business. So going into a partnership needs to be carefully considered, because the decision of one partner binds the other partner to that decision. So if your friend, your partner, if they cause the business to be unsuccessful and to lose money, it will also be your fault, or it will also be you will carry that risk together. So partnerships also have unlimited liability, where the partners are responsible for the debts of the business. So if your partner screws up and your business goes bankrupt, you will also carry that risk, and they will come and take your personal belongings until the debt is paid off. So a partnership is a business owned by at least 2 people or partners. We call them partners, and it can be up to an unlimited number of owners called partners. There are no legal requirements to start and run a partnership. All you need is a partnership agreement. It's either written or it's oral. Okay, so that is all you need. And in a partnership, they are jointly and severally responsible for all the debts of the partnership. And the death or retirement of one partner terminates the agreement. So therefore we say that the partnership agreement, or is also the continuity of the partnership, is limited. Why is the continuity of a partnership limited? Because if one partner steps out of the business, or you get a new partner into the partnership, you need to draw up a new partnership agreement. So the previous partnership agreement is not valid anymore. Therefore, we say limited continuity. Okay. All right, we are now going to look at companies. Companies, profit companies. We're going to look at private company and a public company. We're going to first start with a private company. Now, I have attached a picture there that says PTY Ltd. When you register a private company, your name needs to end with PTY Ltd. A company is governed by the Companies Act and must comply with a whole series of requirements. A board of directors must be appointed, and all the names of the members of the board, the directors, have to be made available to the public register of companies. Complete audited financial statements have to be submitted annually. There are also specific regulations with regard to holding general meetings. We call that meetings AGMs, or annual general meetings. All of these requirements make the founding and management of a company very expensive. The name of the private company must end with the words PTY Ltd. What does it stand for? Proprietary Limited. Okay, in your books, your textbooks, they start discussing the companies on page 144, and they say a company is a form of ownership for a business that usually needs a large capital investment. A single owner is unlikely to have this amount of money, and banks are not likely to lend such a large amount of money to get the business up and running. People and other businesses are invited to become owners in the business by buying a share in the public. Now, that is a public company. In a private company, you do not invite the public to buy shares from you. You only offer shares to your shareholders within the company. An example of this is if you look at the Netcare hospitals. They are part of a private company. And when you are a doctor and you want to work there, you need to invest money into the business. So you invest money and you get a certain percentage of shares in the company. So you are a shareholder based on a specific percentage of shares, and that depends on the money you invested. So you are a shareholder of that company. So people like us, we cannot buy shares from Netcare because it is a private company. Okay, so like closed corporation, it is a form of business that has to be legally registered with the government as a business that is separate from the owners. To do this, the owner have to complete legal documents, and we call this the notice of incorporation, and a memorandum of incorporation needs to be completed when you want to start a company. A notice of incorporation is a document to register a company with the government, whereas an MOI, Memorandum of Incorporation, is a document stating the rights, the duties, and the responsibilities of the shareholders. And that you can find on page 144 in your textbook. Okay, now the most important thing here at the companies, the private companies, is that you need to know that a private company is a company that does not sell its shares to the public. Does not sell its shares to the public. Okay. Have a public company. Now, a public company is distinguished as a legal entity. Okay, now we're going to talk about that a little bit later. But a public company sells their shares to the public. So they invite the public by means of a prospectus. We call that a prospectus. And that is an invitation to the public to buy shares from your business. So the thing about the public company is that all your information is freely available for the public to see. So your financial statements and everything gets seen by the public because the public wants to invest in your company. And they will not know if you are a good company to invest in if they haven't seen all your documents. So a public company is also managed by a board of directors, and the decisions are made by shareholders. But the public can also be a shareholder. Now, if you buy shares in, let's say, in Woolworths or in ABSA Bank, then it doesn't mean that you can make decisions now on the company's behalf. You can't do that. You just become part of the company, and when the company makes profit, your shares value will go up. So let's say you bought 10 shares and each share went up by 1 rand, you will make 10 rand profit or 10 rand dividends. So the difference between a public and a private company is that a private company cannot sell shares to the public. And a public company, by means of a prospectus, they invite the public to buy shares from them. We are now going to look at a closed corporation. Just please note that a closed corporation may no longer be registered. And existing closed corporations are currently regulated by the Company Act, so you can commence your business if you started a closed corporation 10 years ago or longer. Characteristics of a sole trader. Okay, now we're going to look at the characteristics. A sole trader belongs to one person. They provide capital themselves